So picture this. It is 2008, right? The global financial system is literally collapsing around us.
Yeah, total meltdown.
Exactly.
Yeah.
And there is this one investor who calmly, without blinking, deploys $7 billion.
Wow.
Right. He looked at this absolute market panic and basically treated it like the ultimate buying opportunity. But here is the crazy part. Today, that exact same investor is looking at artificial intelligence, and he's admitting that he is genuinely terrified.
I mean, it is the ultimate paradox. You have someone who literally built an entire empire on quantifying risk,
Right.
right? And now he is staring down a new technology and openly stating that his traditional models are just, well, they're useless.
Yeah, completely useless. We were talking about the legendary investor Howard Marks. So today we are taking a deep dive into his recent, incredibly candid interview on the My First Million channel.
It was such a good interview.
It really was. The mission here is to unpack Marx's sudden, evolving panic regarding AI. But we aren't stopping there. We are using that shift to decode his masterclass on what he calls second-level thinking during crises.
Right, which is crucial.
Totally. We are going to dig into the actual mechanics of that $7 billion bet, extract his non-negotiable rules for lifelong partnerships, and figure out how he navigates a world he believes is entirely driven by randomness.
And since we are going to be discussing market temperatures and macro investing calls today, I want to mention there is a really relevant resource for you to check out. To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join Deep Values, APP. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play.
Awesome.
And before we get into it, just a quick note, disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
All right, let's unpack this. Because Marx didn't just casually mention a mild concern about AI, he experienced this whiplash-inducing epiphany.
Yeah, it was fast.
Super fast. Back in December, he wrote a memo primarily exploring the possibility of an AI market bubble, very standard Wall Street stuff. But by early February, which is barely 2 months later, he had entirely rewritten his worldview.
And the catalyst for that was actually his son, right?
Exactly. His son Andrew, who is a venture capitalist, Andrew spends his days in the trenches with these AI startups, and he basically staged an intervention. He told his dad that the legacy frameworks for understanding how fast tech moves, they were no longer applicable.
Because Marx realized he was dealing with two unprecedented qualities that previous tech leaps simply did not have.
Right.
The first one is pure unpredictability. I mean, when the internet arrived, it was massively disruptive, sure, but you could somewhat chart the trajectory.
You could see where it was going.
Exactly. You could see it would change commerce or communication or media. But with AI, Marx points out that literally no one, not even the engineers or the top investors, knows the actual shape of its future.
That is wild.
But the second quality is the one that really rattled him, and that is autonomy.
Yes, autonomy. That is the core difference here, because look back at the railroad or the personal computer or even early software. Those were essentially highly efficient power drills.
Right, they sped things up.
Exactly. A power drill makes you exponentially faster at driving a screw, but you, the humans, still have to plug it in. You have to aim it, pull the trigger, and actually design the house. AI is not a power drill.
Not at all.
It is like hiring a general contractor who goes to the lumberyard, buys the wood, draws up the blueprints, and builds the entire house without you ever telling them how to do it. You just assign the goal, and the machine figures out the process.
And that mechanism of autonomy fundamentally changes the value of human labor. You give AI a goal, and it utilizes virtually limitless data to achieve it entirely on its own. Marx brought up Warren Buffett's early career to illustrate this, which I thought was a great example. A massive part of Buffett's historical edge was just his sheer endurance.
Oh, the Moody's manual.
Yes. He would sit down with an 800-page Moody's financial manual and read it cover to cover. He was analyzing thousands of obscure companies just to find one tiny piece of mispriced information.
Just grinding it
Yeah,
out.
exactly. It was an information asymmetry advantage, but it was built on physical endurance. Today, an AI model can ingest, cross-reference, and analyze that entire manual in a literal heartbeat.
So if an AI can execute the heavy lifting of a billionaire investor in a fraction of a second, the obvious question is, are human investors obsolete?
Right. It makes you wonder.
Marx draws a chilling parallel here to the rise of index funds. Decades ago, the financial world was totally dominated by active equity managers. Then index funds came along and proved mathematically that most of these average, mediocre experts couldn't actually beat the market over time.
And index funds absolutely decimated that industry.
They really did.
Yeah.
And Marx sees AI operating as a similar mechanism. He says it is going to unfrock or defrock an enormous layer of average experts.
Because if your primary value proposition as a professional, whether you are a junior lawyer or a financial analyst or a researcher, is just your ability to gather, summarize, and compare data, your edge is completely gone.
Gone. Yeah.
AI performs those mechanical tasks faster, without arithmetic errors, and critically, without the emotional fatigue that plagues human workers. So the domain of cognitive tasks, once reserved exclusively for educated humans, is shrinking, and it is shrinking rapidly.
But if a machine can process historical data flawlessly, the game is no longer about processing data. It becomes about what the machine cannot process.
It's like the blind spot.
Right. AI has a massive structural blind spot. By definition, large language models and machine learning systems train on history. They require massive data sets of past events to recognize patterns and extrapolate futures. So the system inherently breaks down when it encounters a truly unprecedented event.
What's fascinating here is that the perfection of the machine actually highlights the enduring, irreplaceable value of human messiness.
Oh, I love that phrase, human messiness.
Yeah, because Marx emphasizes that AI lacks the hair on the back of the neck, that visceral, unquantifiable intuition you get when you are evaluating a situation.
Right, like a gut feeling.
Exactly. You could be analyzing a startup, and the spreadsheets are immaculate, the revenue models are perfect, but you sit across the table from the founder and your stomach drops. You sense a flaw in their character, or maybe a hint of deceit, or a fatal lack of resilience. AI cannot sense a bad actor if the bad actor submits perfect paperwork.
Because it has no biological instinct for danger. And this connects directly to Marx's foundational philosophy from his book, The Most Important Thing. He calls it second-level thinking.
Yes, this is such a crucial concept.
It really is.
Mhm.
So first-level thinking is looking at a highly profitable tech company and saying, oh, this is a great business, I should buy the stock. That is the consensus view. But Marx argues that if your investment thesis is identical to the consensus, you cannot mathematically outperform the market.
Because the current stock price already reflects that consensus.
Exactly. To win, you must possess what he calls a variant perception.
Let's break down the mechanics of a variant perception. Because it means you are analyzing the exact same public data as everyone else on Wall Street. The same earnings reports, the same macro indicators, but you arrive at a wildly different conclusion.
Right.
Perhaps the consensus sees a sudden drop in the company's quarterly earnings and panics, driving the stock price down. Your variant perception might be recognizing that the drop is just a one-time accounting write-off that is actually hiding massive core operational growth.
But having a contrarian opinion isn't enough.
No, not at all. You also have to be right. A contrarian who is wrong is just a fool losing money. But a contrarian who is right is a visionary.
Wait, but Marx actually argues that he cannot teach someone how to be a second-level thinker. He compares financial insight to height in basketball, which implies that it is an innate genetic gift. You either have the wiring or you don't.
That is a tough pill to swallow for a lot of people.
It really is. But I have to push back here. Is this variant perception really a magical trait you are born with? Or is it more like pattern recognition, like a chess grandmaster who just learned to look 3 moves ahead instead of 1?
So Marx makes a very careful distinction there. He says he can teach you the framework of second-level thinking. He can teach you to constantly ask, what does the crowd believe and where are they wrong?
Okay, so the concept is teachable.
Yes, the concept is. What he cannot teach is the intuitive leap required to consistently identify the correct variant perception in real time.
I see.
Like, you can teach the rules of chess, but spotting an obscure trap on a chaotic board requires a synthesis of experience, probability assessment, and a psychological detachment from the crowd that some people simply cannot master no matter how much they study.
And the ultimate stress test of that psychological detachment is surviving a scenario with 0 historical precedent. Which brings us to how this plays out in the real world, specifically the 2008 financial crisis.
Right.
This is a moment where an AI would have entirely frozen up because its training data wouldn't contain a model for the total collapse of the modern banking system.
Exactly. And the setup for that actually began in 2007. Marx and his business partner, Bruce Karsh, were observing the market and recognized a terrifying absence of discipline.
What does that mean, absence of discipline?
Well, a healthy market acts as a gatekeeper. It looks at terrible business plans and refuses to fund them. But in the lead up to the housing crash, the market was financing absolutely everything. Bad behavior was being systematically rewarded.
Oh, right. Ninja loans and all that.
Exactly. So anticipating a severe correction, they raised an $11 billion distressed debt fund. To put that in perspective, their previous fund of that type was only $2.5 billion.
So they were building the ark before it started raining. They knew they had to raise the capital while everyone was still euphoric because once the panic sets in, liquidity dries up and no one will give you a dime.
Yep.
Fast forward to September 2008, Lehman Brothers goes bankrupt. The conversation on Wall Street shifts from a standard recession to the literal atomization of global finance. I mean, people thought ATMs were going to stop working.
It was a true unprecedented event. There is this prominent epidemiologist who once noted that decision-making in a crisis relies on three pillars: data, analogies to past experience, and supposition.
Okay.
Following Lehman's collapse, there was zero data on how to handle the evaporation of the interconnected banking system. There were no valid analogies. There was only pure supposition. So deploying capital in that environment requires extraordinary intellectual clarity.
Here's where it gets really interesting. How do you convince yourself to buy when the world might be ending?
Right. How do you do it?
You rely on a brutally rational, asymmetric mathematical framework. Marx and his team looked at the board and realized their outcomes were completely skewed. If the global financial system actually melts down to bedrock, the concept of money becomes meaningless.
Right. Canned goods and shotguns become the only currency.
Exactly. So if they invest and it goes to zero, it doesn't matter because everyone is wiped out anyway. But if the world survives and they chose to hide their cash out of fear, they would have profoundly failed their investors by missing generational bargains.
And the mechanics of what they were buying protected them as well.
Right.
They were purchasing distressed debt. Let's explain why that matters for a second.
Yeah, please do.
In the capital structure of a company, debt holders are senior to equity holders. If a company goes bankrupt, the equity, meaning the stock, goes to zero. But the bond holders have a legal claim on the actual physical assets. Marx and Karsh were buying debt for pennies on the dollar. The math dictated that even if these companies were liquidated and the literal office chairs were sold off, the fund would still likely break even. They had a massive margin of safety.
Wow.
Once they realized that, Karsh began deploying an average of $450 million a week for 15 straight weeks, $7 billion in a single quarter.
That reality completely shatters the Hollywood myth of the alpha investor. I mean, we are so conditioned to picture the Wolf of Wall Street, the master of the universe, pounding the table, absolutely certain, screaming at everyone to buy.
But that wasn't the reality at all.
Not at all. Marx openly admits they were terrified. They were reading the exact same apocalyptic newspaper headlines as everyone else. Their stomachs were churning. But Marx defines a hero not as someone devoid of fear, but as someone who is terrified, feels the instinct to run, and still charges forward because the math and the mission demand it.
Because if you wait for the fear to dissipate before you invest, the opportunity is already gone. The bargains only exist as a direct result of the fear.
Exactly.
It brings to mind a quote attributed to Mark Twain that Marx references, which is, "It ain't what you don't know that gets you into trouble. It's what you know for certain that just ain't true."
Oh, that is so good.
The investors who were annihilated in 2008 were the ones who were 100% certain that national housing prices could never decline. Marx survived precisely because he acknowledges his own ignorance. He operates probabilistically, constantly telling himself, "I believe I am right, but I could be entirely wrong."
Executing a strategy like that, though dumping $500 million a week into an abyss of panic, is psychologically devastating. Doing it alone would likely break a person.
Oh, for sure.
Marx survived the pressure cooker of 2008 because of a massive hidden advantage, which is his partnership. He and Bruce Karsh have worked together for 39 years, managing billions through multiple market cycles, and they claim to have never had a single argument.
A 39-year streak with zero conflicts in the high-stakes world of finance is practically a statistical impossibility.
It really is.
Marx attributes this endurance to two rigid pillars: shared values and complementary skills. The shared values component is fundamentally about risk tolerance and ethical alignment. Marx uses this analogy of cowboys and chickens.
Cowboys and chickens.
Yeah. If one partner is a hyper-aggressive cowboy seeking maximum risk for maximum return, and the other is a conservative chicken terrified of losing capital, The partnership is absolutely
I
doomed.
mean, you can apply that to anything in your life, right? Whether you are launching a startup or even managing household finances in a marriage. If you are desperately pulling the parachute while your partner is slamming the gas pedal, the resentment will eventually tear you apart.
Exactly.
You must be aligned on the core philosophy. And crucially, Marx notes that neither he nor Karsh are financial maximizers.
Right, they aren't greedy.
Yeah, they are not obsessed with squeezing the final bloody nickel out of every single deal. And he says most catastrophic business divorces occur over a fight for that last nickel.
And once those values are aligned, the second pillar is complementary skills. Because if two partners possess the exact same skill set, eventually one realizes the other is redundant.
That makes sense.
Their division of labor requires massive ego suppression. Marx is the philosopher in the public face. He writes the legendary memos, he travels to meet clients, and communicates the overarching strategy. Karch has zero interest in the spotlight. He stays at the desk, actively managing the billions of dollars.
So they stay in their lanes.
Exactly. They deeply respect each other's domain, and more importantly, they're profoundly grateful they don't have to perform each other's jobs.
That level of ego suppression really echoes the most famous partnership in the history of capitalism, which is Warren Buffett and the late Charlie Munger.
Yes, the ultimate duo.
And Marx actually crossed paths with Buffett due to a highly complex, distressed debt situation during the Enron collapse. Mark's firm and Buffett were the two largest debt holders in a specific off-balance sheet entity.
Oh, wow. I didn't know that.
Yeah, and Buffett basically just handed Marx his proxy to restructure the incredibly messy legal situation. They succeeded, they made a fortune, and it led to this lifelong mutual respect.
And while Marx respects Buffett immensely, he points to Munger's influence on Buffett to highlight how complementary intelligence changes everything.
How so?
While people often assume Buffett was born as the ultimate compounding machine, but Marx highlights that Munger's greatest contribution was curing Buffett of cigar butt investing.
The cigar butt metaphor is such a brilliantly gross visual. Imagine walking down the street, spotting a wet, discarded cigar butt in the gutter, and picking it up simply because there are 3 free puffs left in it.
Yeah, it's pretty evocative.
Early in his career, operating under the philosophy of his mentor Benjamin Graham, Buffett would buy terrible, failing companies. He bought them because they were trading so far below their liquidation value that he could guarantee a quick, small profit. He was constantly digging in the gutter for free puffs.
And the mechanism of cigar butt investing is just exhausting because you have to constantly find new targets. A bad business creates constant problems requiring endless managerial intervention.
Right.
Munger, who possessed a towering intellect but leaned more toward classical philosophy and worldly wisdom, fundamentally altered Buffett's math. Munger convinced him that it is exponentially better to buy a wonderful company at a fair price than a terrible company at a wonderful price.
Because a great business is a self-sustaining machine.
Exactly. It compounds capital internally over decades without requiring you to constantly search for the next discarded cigar. Buffett was the ultimate calculator, but Munger was the architect of the logic. Together, they formed this unbeatable synergy built on trust, ego suppression, and humor.
You know, zooming out from Wall Street for a second, what is truly compelling is how Marx applies this entire philosophy, the embrace of humility, the suppression of ego, and the acceptance of uncertainty to the actual design of a human life.
Yeah, he gets very personal.
He is incredibly candid about his own trajectory. We view him today as a grandmaster who foresaw every move, but he openly admits his first 2 decades were a series of haphazard, lucky accidents.
If we connect this to the bigger picture, Mark's story is a profound lesson in acknowledging randomness. Why did he start at Citibank in 1969? Simply because they offered him a summer internship.
Right.
Why did he move to California in 1980? He was tired of the cold and wanted palm trees. How did he end up pioneering the incredibly lucrative field of high-yield bonds? Because a supervisor randomly asked him to look into a guy named Michael Milken.
That is insane.
Marx acknowledges that if he had been out sick the day that assignment was handed out, someone else would be living his life right now.
Hearing a billionaire credit cheering dumb luck is stunning. I mean, most highly successful individuals aggressively rewrite their own histories. They construct this narrative where they were playing 4D chess from the cradle.
Oh, absolutely.
But Marx embraces the chaos. His core advice for navigating it comes from the writer Christopher Morley. He says, there is only one success: to live your life your own way. He advises people to ruthlessly audit themselves. Find what plays to your natural strengths, actively avoid your weaknesses, and figure out what actually brings you joy.
Which sounds simple, but it isn't.
No, because the most difficult step is actively ignoring the heavy demands of society, your peers, and your parents.
And that view of autonomy heavily shapes his philosophy on parenting, too.
Mm.
Marx shared a really striking observation from a psychiatrist who operated on Wall Street decades ago.
Oh, I remember this part.
Yeah, this doctor noted a direct inverse correlation between his highly successful male patients' psychological well-being and the behavior of their fathers. The men who were complete psychological disasters often had fathers who constantly competed with them, undermined them, or just treated them as subordinates to be managed.
Marx views the compulsion of successful men to assert intellectual superiority over their own children as an absolute tragedy.
It really is.
His fundamental rule is to relinquish control. You have to let your children make their own choices, especially when you are certain they are making a mistake. He talked about letting his daughter choose her high school against his own preference.
Right, because you can't protect them from everything?
Exactly. You cannot shield them from the randomness of the universe. The only way they build resilience is by experiencing the consequences of incorrect choices. You are not managing an employee, you are equipping a human.
And to fully grasp how much chance dictates our outcomes, Marx points to two foundational books. The first is A Short History of Financial Euphoria by John Kenneth Galbraith.
Great book.
It breaks down the psychological frailties that cause humans to consistently generate market bubbles and crashes. It's basically a manual for understanding crowd delusion.
And the second one.
The second is Fooled by Randomness by Nassim Nicholas Taleb. That book crystallized Marx's understanding that short-term outcomes in markets and in life are largely dictated by variance. Internalizing the sheer weight of randomness forces you to stay humble. It prevents you from making catastrophic bets based on overconfidence, and honestly, it just stops you from taking yourself too seriously.
Well, we have covered massive ground today. We started with the existential threat of an autonomous AI, a machine that can process the entirety of human financial history instantly, threatening to render the average white-collar expert completely obsolete.
But we also saw how that perfection exposes the enduring necessity of human intuition.
Yes. The variant perception, the hair on the back of your neck. We broke down the mechanics of surviving a crisis, learning that true courage isn't the absence of doubt. It is doing the terrifying math and deploying the capital despite your trepidation. We explored how suppressing your ego and finding complementary skills is the only way to sustain a partnership, whether you are managing billions or managing a household. And ultimately, we learned that embracing the sheer randomness of the universe doesn't make you powerless. It makes you a more resilient investor, a better parent, and a wiser human being.
True mastery of your field or your life isn't about perfectly predicting the future. That is just impossible. It is about understanding the boundaries of your own knowledge, aligning yourself with partners who cover your blind spots, and making the most rational, probabilistic choices you can when the crisis inevitably arrives.
Howard Marks built a financial empire by mastering the variant perception. He looked at the exact same terrifying headlines, the exact same market data as the rest of the world, but he possessed the courage to conclude something entirely different from the consensus. So take a hard look at your own life and career right now. Where are you simply accepting the consensus view? Where are you following the crowd just because there is safety in numbers? And what would your variant perception look like if you finally trusted the hair standing up in the back of your neck?